Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN Sunday, or Sunday, April 23rd, 2023. We've got members of the media, academia, financial services, and government standing by as we analyze all the news and events for the week. So sit back, relax, enjoy this episode of BRN Sunday.
You're tired of the same old story. Oh, turn some pages. I'll be here when you are ready. Roll with the changes. Yeah, yeah. I knew it had to happen. Felt the tables turning. You got me through my darkest hour. I heard the thunder clapping, and I felt the desert burning. Until you poured on me like a sweet sunshine. That's right. But if you're tired of the same old story, oh, turn some pages. I'll be here when you are ready to roll with the changes. If you're tired of the same old story, whoa, baby, turn some pages.
Well, we're going to kick off the show, as we always do, with a look at what's happening on Capitol Hill in terms of legislation, litigation, regulation, arbitration. Joining us on the line, he's one half of the famed Legal Eagles. David Levine is a principal with Groom Law Group. That is an employee benefits law firm based in Washington, D.C. David, thanks so much for making some time with us this morning.
Jeff, as always, it's a pleasure to be here, and I look forward to a couple minutes of chatting with you today.
Yeah, this is great, David. And I know we wanted to talk a little bit about privacy, but we also want to talk about legislation or pending proposed legislation. There's a lot going on in Capitol Hill these days when it comes to retirement.
There is, and Jeff, you are so right. We all know that Kevin and I would do our segments, it felt like weekly, on Secure 2.0 for a while there. And then we said, everybody's exhausted. They're done with legislation. So this will be a year of less legislation. And that is true. But there has been some potential legislation really getting some attention recently. So I thought this week maybe we'd talk about that a little and then dovetail into privacy and privacy legislation that could be out there.
Let's do it. Let's do it, David.
So many of you may have seen recently that there is a bunch of discussion in the trade press about potential legislation that would create a federalized version of basically the defined contribution system. It's been promoted by a number of people, some academics, some not, and some in the industry have put out articles saying they're very concerned about this. Obviously, this would be a dramatic change to the industry, and it really raises a core question. We've already grown much more accepting over the last 5 years of, I'll call it, these state-run IRA programs, the secure choice IRAs. And I think people view those as expanding coverage. And even from an industry perspective, you see more and more people in industry at this point viewing these new programs at the state level as A, encouraging savings, B, encouraging people to create 401k plans, and C, we do live in a capitalist society, creating business opportunities, which are all great positives. The proposal for a federal system, on the other hand, has raised some real questions out there amongst people, because there is concern, well, does it automatically get preference over the private system? And the legislation hasn't moved far, if at all, at this point. It's about, is it going to be reintroduced in different forms? Is it going to go forward? But it really brings up a fundamental discussion. How should the retirement system work? My personal belief is that whether or not you have a federal system, our current system is a voluntary one. We all know there was a lot of pushback on mandates in the Affordable Care Act, and that battle continues to this day. But the participation in the retirement system is voluntary with a 401k and defined contribution plan. And I think there is concern that this is pushing more towards a mandate with some. And I think there's a lot of dialogue to come. So what are you supposed to do if you're a service provider? Clearly, you can weigh in. We have clients we're weighing in with. You can figure out what product solution you might fit in that space. But of course, we all know the TSP doesn't have every provider under the sun. They have a small group. Similarly, if you're a plan sponsor, there is some interesting discussions there. And I liken this to some of the discussions about whether or not people join PEPs. There are some real divisions about whether people want to use a pooled employer plan, especially in the smaller plans. They seem to get more traction, and larger, some people are saying they are, a lot of people they're not. But there's different priorities. What type of control, what type of involvement, what type of responsibility? And I think a lot of this is yet to be determined, but I think it's part of the never-ending discussion. But let me pivot, if I might, into privacy.
Yeah.
Because Kevin and I have talked with you a number of times about privacy. Privacy remains something that is brought up in litigation. There is some agreement in some ways on the left and the right, but maybe not in the center all the time, on the need for some type of federal privacy standards. But we get into the weeds because you have places like California with the CCPA in California, and it leaves an interesting question of where is privacy going? I think from a service provider standpoint, we are working with and we are seeing a number of service providers taking different approaches to their business. For instance, in California, now that the CCPA is live and the carve out that Kevin and I worked on years ago for employment-related benefits has effectively sunset for the time being. So we are seeing some vendors come out with CCPA addenda to their products. Other people are saying it's preempted, and there's a lot to discuss as we go forward at this moment. So that's something to think about there. In terms of federal legislation, there's emerging consensus, and Republican control in the House might have some impact in terms of moving things because there were some Democrats who were opposed to federal legislation before, but we have a lot to see. So we'll see what goes on from here.
David, I want to thank you for that. I would just want to pivot back, ask you a couple questions, if I could, about the proposed legislation. And yeah, I mean, obviously there's a lot of debate on what the role of the federal government should be. We're not going to have that conversation because that's not going to, that's not what we're focused on. But this is proposed legislation, or will be proposed legislation. It's been proposed before. Isn't it just a conversation starter? Because, you think about the complexities of getting a piece of legislation through. We saw this with Secure 2.0. There's a lot of stuff that goes on and that's talked about. And ultimately, what winds up in the final bill, if there is even a final bill, is a consolidation, amalgamation of all these different concepts.
Agreed. You're spot on, Jeff. And I think the idea of a federal program, I don't anticipate that jumping forward anytime soon, but it's kind of like Rothification. Like years ago, we led a coalition called Save Our Savings, trying to avoid mandatory Rothification. And as evident in Secure 2.0, the mandatory Rothification of catch-ups, which is causing huge concerns about timing and implementation. Maybe we can talk about that another week because there's a lot going on there. There's a lot of discussion. So we will have a lot to discuss.
Yeah. Well, David, we're going to leave it there. Really appreciate you popping by. Give our best to your colleague, Kevin Walsh. And look, we look forward to having you both back on the program again next week.
Thank you so much, Jeff, and have a great weekend, listeners, as well.
Thanks, David. Bye-bye.
Bye-bye, Jeff.
Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and called Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. Now, time to take a look at the markets. We're going to take a spin around the markets, I should say, in the economy. Joining us on the line, he's the lead anchor for the TD Ameritrade Network. He anchors 2 shows there, does a lot of commentary, a lot of contributions. Oliver Renick. Oliver, thanks so much for joining us on the program this morning.
Absolutely, Jeff. Thanks for having me.
Yeah, it's always a pleasure to talk to you. All right, Oliver, give us a tour around the markets this week.
Yeah, it is a tour that goes round and round in circles. It has been very, very sleepy. The market keeps going back and forth. Tech companies in the NASDAQ essentially have been very sideways bound. And the VIX keeps dropping as a result. So volatility has become really subdued. Markets seem to have found kind of a sweet spot right now, and it creates for some very interesting situations potentially, because we haven't seen volatility this low in a very long time. For about 5 years, going back to before COVID, the VIX, which measures 30-day volatility in the S&P on an expected options basis, has been trending higher. And it's something that I've watched very carefully, because essentially what it shows is that anytime investors have thought they're out of the woods, they haven't been. Something has come along and volatility has bottomed at an increasingly higher level. And this actually goes back to before COVID. It goes back to early 2018, the preceding 6 to 8 months before the first attempt at hiking rates in 2018, when a bunch of short volatility products designed to short the VIX all blew up and the VIX spiked. Since then, the VIX hasn't really been the same. It's been trending higher. And this week, for the first time, we saw a real meaningful break in trend. The VIX trading as low as 16 is really something very novel. especially in the context of the COVID period and the inflation-plagued COVID recovery of last year. And so this certainly has bulls very optimistic, and for the most part, the charts reflect that. Stocks have remained well bid. Dips are getting bought. We saw a little bit of a crack in Tesla as the market was not happy with the number they reported, despite everyone knowing that their margins were going to shrink. So that to me is sometimes a red flag when something is very extremely well telegraphed and still leads to selling anyway. So on the margin, there's a little bit of fraying of some of the optimism, but I imagine we're not going to really pick a direction until we get through Microsoft, Apple, and the big tech earnings that are coming up, because the market really is pinned right now. And the onus, though, remains on the bears to prove that they have a case, because right now they have really been absent from the conversation.
Oliver, you talk to a lot of money managers, you talk to a lot of financial advisors on the program. Is there a consensus? Is there a commonality in terms of what they're telling their clients about this market? You know, if you're a layperson like myself, you're looking at the outside looking in, it's kind of hard to figure out which direction things are going to go and to make the right decisions for your investments.
Yeah, I'd say a good chunk of my guests still recommend buying the dip from last year in tech companies. These are stocks that have reclaimed a lot of lost ground, but there is still definitely a very bullish community out there that believes we will see new highs in Apple, we will see new highs in Tesla, that we will see new highs in Microsoft, that these are all very secular, reliable growth themes. That's certainly questionable. There is a lot of reason to believe that the Federal Reserve is not going to be able to cut interest rates, and that the expectations for them to do so are very outlandish at this point. So that's kind of a problem for assuming that tech will continue to rise and taking an approach that tech should be a ballast in your portfolio. There is also a good bit of bullishness that I hear in a lot of strategies that center around buying high quality, cash flow heavy, dividend paying companies, staples like Coke, Procter & Gamble, McDonald's. That's a strategy that I think resonates with me a little bit better. Those are pretty good looking charts still, for the most part, more stable, reliable, and still making you money despite the volatility and the ups and downs of some of the high tech stuff. So it's going to be a very important couple of weeks. The most important company is going to be Microsoft, because this latest rally in technology has really centered around this artificial intelligence theme and assessing whether or not AI is a hype train like blockchain and metaverse and all these other stories that never lived up to their potential, or if it's something very real and profit generating, which I think it definitely has more potential to be, then Microsoft should be a very good way to see that.
Yeah. Oliver, I was reading somewhere that they're going to replace us show hosts and anchors with artificial intelligence. Any thoughts about that?
I think that should be difficult, but I don't know. I could be wrong.
I'm just playing with you. I didn't read anything about that. I'm trying to imagine how anything. Wow, just playing with it. But I'm trying to figure out. You talk about this AI theme, and there always seems to be some kind of theme, whether it's climate, sustainable investing, retirement income, and now we've got artificial intelligence. It started with like Chat GPT, and now every article I read, Oliver, is about AI. Not every article, but it's in pretty much every mainstream article I can find. It's going to take away your jobs. It's going to be embedded in financial services, et cetera. You're right. These trends, they never live up to the hype.
I think this one has the potential to, because you can kind of already see some natural things, and there's so much that already is AI. You know, that's kind of my main kind of qualm with the way it's being framed right now is and the way it's being reflected in the stock market. People are saying, oh, there's all these new things AI is going to do. And I mean, the answer is yes, always. I mean, inventing the wheel is AI. I mean, depending on how you frame it, it's just there's a lot of things that can qualify as AI. And in many ways, any technological development that removes the physical workload of people is AI, basically. I know that's not like a real definition of like a technical, AI, but that's the way I think about it from a practical standpoint. And we're always doing that. Humans are always removing their workload by passing it off to some invention. It's the nature of what we do. And we always have been.
I'm sorry, go ahead.
No, yeah, I mean, that's pretty much it. So, yeah, I mean, when you frame it that way, there's like nothing that new.
No, I mean, I think you're right. I mean, it's just another hype for the purposes of hyping tech stocks or hyping those that are quote unquote in the AI game. But I agree with your general thesis. And look, it's nice to know that AI was being used by the cavemen and women when they were creating the wheel or whoever.
Yeah, I guess maybe I'm stretching there.
No, Eli or the cotton gin, right? No, I get the point. Oliver, always a pleasure chatting with you. And I like Thanks, getting the market conversation, but I also like the cultural and conceptual conversations that we have. Thanks so much for joining us. Enjoy the rest of your weekend. And we'll talk to you again very soon.
All right, see you, man.
Bye-bye.
And that wraps up this episode of BRN Sunday. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, visit our website and, of course, all of our streaming partners. We're back again tomorrow for another edition of BRN AM. I'll have a very special guest. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.